Hello guys and welcome back to the channel. Now I know it's been a while, I've been quite busy, I've had some personal projects going on, I've got a new job that I start at the end of this month, I've got holidays, I've been been playing golf as you can see, but we are back today with an update on my stocks and shares ISA portfolio. Now markets have been going crazy, there's been a lot going on the politics side, on the market side, on the stocks specific side, so yeah, there's a lot to talk about in this episode, so we'll just jump straight in and go from there. Before we do that, just need to remind everyone that this is not financial advice. This video is for education and entertainment purposes only. So with that said, we'll come on to the Excel dashboard. Okay, Excel dashboard. Starting off at the bottom as per usual with the contributions box. Sadly, once again, I have not been able to contribute. Now, as I mentioned in the intro, this is a couple of things. I'm sort of building up a buffer for my new job. I'm moving to London imminently, which will be costly. Got trains to buy, or train tickets to buy, cars, car park places to buy. Rent's obviously going to be a big one. Need to get a deposit sorted for that. So that's eaten into things. I'm also going away in a couple of weeks, so I've needed money for that as sort of a buffer. So again, since August, I haven't been able to add to this portfolio, which has been annoying. But when we come on to talk about the markets, it isn't actually such a big deal because I think markets are overextended. They have been overextended for quite some time. And if there was ever a time in the last few years that I wouldn't have wanted to put money in, it would have been over the last few months. Matched probably only by the height of lockdown mania in 2020 and 2021. So that's that. Scrolling up, you can see, let's go to the portfolio at the top. It's not changed. I haven't moved any funds around. We've still got the same 6 funds, 3 aggressive, 3 more defensive. Aggressive ones, or more, the ones that will do better in more optimistic markets, let's say Columbia Threadneedle American Smaller Companies, which is a US small cap fund, Henderson Tech Leaders, which is obviously a technology fund, and then BlackRock Global Equity Unconstrained, which is like a best ideas global equity portfolio from BlackRock, but it's naturally quite sort of growthy. So you've got names like ASML, LVMH, what else? Novo Nordisk was in there for a time. TSMC is probably in there. So all these sort of growthy names that have done well in this recent rally. And then you've got the more defensive holdings in the form of Polar Capital Global Insurance, L&G Health and Pharma, and Fidelity Special Situations. The first two speak for themselves. Fidelity is a UK equity fund. And looking at the gain bar, the gain sort of column here, you can see that broadly they've stuck to their remit. There's 2 outliers to that, but you can see the aggressive funds in BlackRock and and Henderson have smashed it, or done at least all right. Fidelity Special Situations, the UK has had a lot of tailwinds recently. It's done really well. So that, even though it's more defensive, has done really well too. And then what else have we got? Columbia Threadneedle American Smaller Companies has been an outlier because despite the market rallying so hard, that one hasn't. And that's mostly been because small caps have been relatively unloved. It's mostly been, I mean, we'll come on to talk about we might as well do it now. Markets have been a bit funny, not just over the last few months, but over the last few years, in that it's been very concentrated rallies. It's always been, it was a FANGs initially, Facebook, Apple, Alphabet, Netflix, was it Alphabet or no, Amazon, then Google, and now it's the Magnificent Seven, which I'm sure you'll be aware of. And for me, it's all well and good. They might continue to do fine, but internally in my head, I don't really have a benchmark for my own investments. As long as I can do sort of low double-digit returns over the long term, even high single digits, because low double digits is sort of pushing it, but I'm somewhat confident I can do that. Then I'm happy, even if the index goes up 20% a year. That just is what it is. That's an anomaly, in my opinion. But yeah, smaller companies have been left out of the rally as a result of everything that's going on in the market dynamics. So that's been hit. And then the more defensive holdings in health and pharma and insurance, I have been disappointed by the lack of upside participation. But ultimately, I think it's not an earnings story. The insurers had their earnings this week and they were very strong. I might throw some quotes up on screen from some of the CEOs there. But the book value growth is approaching 20% in a lot of cases. And historically, share price has tracked book value growth. But obviously when that doesn't happen, on the downside, in my opinion, all that means you've just got a coiled spring, and that means there's more upside to come. That's how I think about markets and valuations. I'm happy to hold for however many years it takes to get that re-rating. I held UK equity for quite some time before that had a re-rating. You have your 25% that you've had over the last year, 18 months, and you sell it and you move on. Now that doesn't sound crazy in today's markets where the S&P seems to do 20% every year, as I'm sure anyone in the Trading 212 Reddit will tell you. All you have to do is buy the S&P 500 and wait, and you'll be a millionaire in 10 years. But that's typically not how markets work, and I would expect them to come back to normality somewhat soon. Saying that, I have had this thought recently that I'm trying to apply logic to illogical markets. You know, the stuff you learn in finance books or at university, or actually in the field, so to speak, it's not playing out in reality. It hasn't played out in reality for 5+ years, realistically. I mean, I think the masterpiece of this, the best example of this is Tesla stock. I think if you're a Tesla investor and you have a time horizon of anything more than a year, you're not just playing momentum, then you need to have a think. Let's put it that way. But the market is happy to afford Tesla a 3-digit PE multiple for declining sales revenue growth, which is just unbelievable. So that's that. Coming down, I've just rambled about markets for ages there, but has to be done sometimes, especially when you've been off of camera for about a month. Coming to the middle of the screen, you've got our little sort of portfolio value over time charts and table there. The gain bar is now firmly above the contributions bar. You can, when we come onto the charts, you'll see that I started this series just before a big drop in markets. So, this was how I was planning on it looking throughout. But obviously it was below for quite some time, and now it's peaked above. Like I said in my last video a month ago, and clearly it's been wrong so far, or early. Depends on if you're too early, you're wrong. But if you're a bit early, you're not wrong. So I'm getting close to being just wrong. But as I said, I've got a long-term time horizon. If markets could do 20% a year for the next few years, and I do 8 or 9, it is what it is. I wouldn't be too unhappy with that. It's on the downside that I expect to pull it back. But anyway, what I was going to say was I would not be at all surprised if this gain bar ended up back below the contributions bar in the short-term future. Given where markets are, I would expect a pullback. But I am yet to be proven right on that. Let's go on to TrustNet now and look at some charts in a bit more detail about exactly what's gone on. And then I'll wrap up the video. Right, so TrustNet. What you can see on screen is my portfolio in the blue and the global equity sector in red. And I know the chart doesn't make me look too clever, but I'm just going to talk through it briefly here. So I started the series here, and then we had the Trump tariff announcements and the US dollar sell-off. A lot of uncertainty, a lot of fear in markets. Both of them crashed. As I said, ordinarily I would expect to do better in downside markets with the way that my portfolio is set up. But there were two main reasons why that didn't happen. The first was US small caps. They got smashed because of their sort of high relative exposure to the tariffs and all that sort of stuff and the uncertainty. And then you had healthcare, which Trump and RFK have come down on like a ton of bricks, and they continue to do so, and it continues to be a headwind in my portfolio. And that's why I didn't have the downside capture that I would quite like. And then you've had the big rebound. And again, being relatively defensively positioned, especially when my further contributions have gone into the likes of insurance, has meant that I've severely lagged on the upside, where you've got primarily tech, high beta, high volatility names driving the market, which we have done since April. Now, I don't like to see that sort of stuff. When I have seen that, it's normally the sign that markets are getting frothy. And actually, if you take anything away from this video, I would highly recommend Howard Marks' The Memo podcast. It's the best finance and investing podcast there is. Howard Marks is like Warren Buffett levels of market wisdom. he pretty much called the tech bubble in 2001, pretty much called the financial crisis in 2008, made a lot of money from both of those things. And when he starts to get a bit worried, I start to get a bit worried. And when you go online, all you see is people talking about their gains, talking about the US markets, talking about tech and AI and all this sort of stuff. And to me, it's just warning sign, warning sign, warning sign, warning sign. And as long as you can if you can cope with FOMO, I don't really get FOMO anymore. I don't get FOMO anymore. Seeing markets do this does not make me wish I was in an equity tracker. For some people, it does. So you've got to know your own investor psyche in that respect. But for me, I would be getting more defensive here. Not financial advice, but being young, as I imagine you probably are, you kind of have to stay exposed to stocks. It's just the rational place to be. And equally, one of the other wise old sages that have been on a podcast recently was Peter Lynch. And one of his famous quotes is, more money has been lost waiting for corrections than in the corrections themselves, i.e. calling people like me stupid because they're getting defensive. Well, not so much people getting defensive, but maybe shorting or going into cash or whatever it might be, waiting for a crash that might be 1 year, 2 years, 3 years away. All that being said, all that rambling being done, I'm defensive. You see that in the portfolio, and I will continue to be defensive. But let's quickly, just before I wrap up the video, go through some constituent parts of the portfolio. You can see what's driving markets. You can see where the energy in the market is coming from. Henderson Tech Leaders, a technology fund, just stonking away, leading the charge over the last 6 months, up 43.6%, which is just absurd. It's unbelievable what is going on in the tech space. I mean, AI, I'm no AI expert. Obviously, I'm not an AI expert. And there's plenty of ways there's plenty of discussion points around AI. I think for me, the biggest change is, Nvidia is the one leader. Like, no one can compete with them, at least at the moment. But where I'm more concerned about is how sort of physically capital intensive these tech companies that have always been very software based are becoming. It's a warning sign for me. It's not a big thing for the next year or so, but it will be as they depreciate those chips and all that sort of stuff, and it comes through on the net income. But elsewhere in the portfolio, you can see Fidelity has done a fantastic job. UK markets have been storming away. You see F&G at the bottom there. They are the small cap small cap fund, and the health and pharma index. Trying to make a comeback, but not being helped by a weaker US dollar, and small caps really need rate cuts to come into their own. Hasn't happened yet, so I don't expect them to really move very much until we do get that those rate cuts come through. Polar Capital, Global Insurance, I just want to touch on. It's E on the chart. It's that light blue line that sort of curves through the middle. You can see how good it was in the initial drawdown. There was pretty much no downside, and that's a lot of that is algo driven. So, hedge fund managers or whatever say, right, we want to decrease our risk on buckets and increase our risk off buckets. That's all it is. It's just algos, and when you get the sell off, that's where that comes to the forefront. And then when you get this risk on rally, no one's buying the boring stuff. No one's buying the safe stuff. Insurance has pretty much gone sideways for 6 months. For a year, you can see on the chart. But the earnings, the book value is up 20%. So to me, that means there's 20% of stored value. If we get no re-rating from here, we just follow the book value growth upwards, 10 to 15 to 20% a year, depending on how the markets go. And if we do get that re-rating, then you get that on top. I think what I'm looking to do, given I think Polar Capital Global Insurance is now like 35-40% of my portfolio, if we do get that re-rating alongside the earnings story, which I have full faith we will, then I'll look to sort of rebalance that into different areas. But when the market's like this, I've got no reason to be looking to expose myself to the more aggressive areas of the market, let's say. So that was a lot of talking. Hopefully you found some value in this video. If you did, let me know. If you didn't, let me know. Please leave a like, subscribe, and I'll see you in the next one.